We've looked at the differences between investors and traders, and we've also looked at the different types of trading. Today, we're looking at the other side of the investment coin and looking into the different types of investors. First, we got the most common type of investor, the retail investor. A retail investor is a non-professional investor. Most of you likely fall into this category when you start buying small shares of companies like Apple, Amazon, and Netflix. Retail investors often have a wide range of skill levels and specialties. They typically invest in stocks and bonds, but mostly stocks, since bonds are notoriously difficult to trade on most trading platforms. Most retail investors use different brokerages or apps that we're familiar with, like TD Ameritrade, Robinhood, Webull, E-Trade, and a few others. If you buy your own stocks and bonds, you're what's known as a retail investor. If you buy shares in a mutual fund, you're giving your money to an institutional investor. They make investing decisions on behalf of individual members and shareholders. If you look up the largest shareholders of brands you're familiar with, you'll find that institutional investors top many of those lists. Some institutional investors buy shares in a company with the intent of becoming vocal shareholders, while other institutional investors, such as index funds, are passive investors and do not take an interest in the running of the companies in which they invest. Accredited investor is a regulatory designation for individuals or entities that meet a certain criteria, such as an individual net worth of more than $1 million, not including the value of a primary residence like a house, and your individual income has to be at least $200K for each of the past 2 years, plus an additional $200K this year. Accredited investors are able to access certain private market investment opportunities not available to retail investors. If you're an accredited investor and you're investing $5 million of your own money or $25 million of you and another person's money, you are what's known as a qualified investor. These guys typically have even more opportunities than accredited investors. The Investment Company Act of 1940 gives private investment companies and qualified investors access to private funds and investment opportunities not available to anyone else. It's completely exclusive, and it's also less regulated. Above these guys, we have the top of the top, high-end, exclusive type of investor, the sophisticated investor. These guys possess vast amounts of knowledge and experience in markets and business matters, alongside a high net worth that allows them to go for high-risk investment opportunities. Under financial regulation laws, they have a special status, and the judicial treatment for being classified as such varies by county. Some sophisticated investors hold a Series 7, Series 62, and 65 licenses who manage more than $5 million worth of clients' money, while others build companies and sit on board of directors. A sophisticated investor belongs to a class of investors with a high net worth and opportunities that make them capable of increasing returns and lowering risks in markets. Such investors get into investment or business deals that ordinary investors shy from thanks to the opportunity and risk appetite that their net worth and higher incomes provide. Well guys, those are the different types of investors. I hope this information was useful to you, and as always, feel free to like, subscribe, and comment. We here at the studio really appreciate it. And if you want to do something more than just absorb the knowledge and apply it to investing and investing strategies, CFS actually has its own sophisticated investor working with us. And you can actually have access to this sophisticated investor by joining our YouTube membership stewardship program. And if you want more financial content, just feel free to like and subscribe and give us a comment as to what other tips you'd like to hear, what other investment strategies you'd like to know more about, or what other types of market definitions you guys would like.